And a very warm welcome to all of you who have joined us here in London today, as well as to our virtual audience who I understand has dialed in the thousands. Before we begin, a few very quick housekeeping rules. This session will be recorded and we will be taking audience questions throughout, which means that you can simply pop any burning questions you might have on the Q&A box in your device in front of you. Okay, let's begin. As far as economic rebounds go, Africa has certainly faced quite a wobbly one. The pandemic has really impacted the continent, and now a war is raging in Europe and has its impact as well. So how is Africa riding this volatile wave, and have African issuers been able to successfully access international capital markets? Well, to answer exactly these questions and more, joining me here today in London are Ifti Ali, CEO at the African Conservation Development Group, Banji Fehintola, Head of Treasury and Financial Institutions at the African Finance Corporation, James Nelson, Head of Debt Capital Markets Africa at Standard Chartered, and joining us from Dubai, Nimrita Bedi, Regional Head Financing Solutions Africa and the Middle East, as well as one of our speakers we are still waiting for, but I'm going to introduce him anyway, Anish Jain, Chief Treasury Officer at the Export Trading Group. We're having some slight technical difficulties. Hopefully we'll be able to patch him in anytime soon. Okay, let's begin with you, James, if you don't mind. I wanted to delve deeper into these shocks, these volatile markets that we're all navigating, and you are the head of debt capital markets. I mean, bond markets have had quite a choppy start to the year, and probably one of the worst in decades, I would say. So how are borrowers dealing with all of this?
Well, first of all, good afternoon, and thank you very much to our guests for joining us today. I think my bosses are all watching somewhere, so I'm going to try and put some positive spin on this somehow. But no, look, it's been a very, very tough year for capital markets generally, especially debt capital markets and for bond issuers. I think our panel title is all around riding the credit wave. And those of you that have tried to dabble in a bit of bodyboarding know all about those really nasty waves that tend to sort of take you on a bit of a high and then dump your face straight into the sand, and you sort of spend the next 10 meters grinding it along through the sand, and it's not very pleasant. It kind of feels a bit like that right now, as certainly as an originator, an origination business. Having said that, look, it's actually not as bad as all that. We have seen a handful of issuers successfully price year to date. I think volumes are down roughly 42%. Year on year. We have been through crises before. I think 2020, we were all very worried that Africa as a region was going to get very, very badly hit in terms of the medical impact of the pandemic. Thank God that didn't actually happen. And as a consequence, 2021 ended up being an incredibly strong year where we saw record issuance volumes for African issuers. And we had one of our most successful years on record as an origination and distribution business here at Standard Chartered. So it really is about riding those waves. It's about thinking of clever structures and ways to help our borrowers obviously find access to capital where markets are going through these periods of big distortion. I think it's worth just pointing out to the room, I mean, those of you that are closer to the Africa credit space, this will be very, very clear to all of you. But, you know, to provide some context to maybe some of the more marginal participants in this market, you know, Ghana at the end of, so the Ghana sovereign bond space at the end of January was trading in the context of 11%. Today, the sort of benchmark 10-year notes are closer to 19% and a cash price of 50 cents in the dollar. Now, Ghana have a few specific issues that they're dealing with, But I think it's safe to say that even if you look at Nigeria, Kenya, these are sovereigns that are all trading in the context of 11, 12%. So we are undoubtedly in a space where I'm not sure in the 12 years that I've been involved in bond markets, emerging market bond markets, I have ever seen a sort of more prolonged period of this sort of volatility or weakness. So I think clearly the sort of impact that's having on our borrower base is that the plans they did have to issue may have to be adjusted somewhat. I think it really plays to Standard Chartered's strengths. You know, in our credit business, we don't just do bonds. Obviously, we have a huge lending business. We have a huge project export finance business. We have the ability to bridge borrowers to the bond market. So we try and deploy all of those tools in order to help our clients find a solution. But listen, I'm going to take a pause there because I could go on forever. But
Great, fantastic context. So really unprecedented volatility in the market. And Banji, I wonder whether you could provide your perspective here. As a treasurer, you clearly oversee cash flows and revenue. So has this volatility really impacted you massively negatively? Is it all doom and gloom? Or are there any positives? Have you been able to reap any opportunities on the back of this?
Well, thank you so much. And first, thanks Standard Chartered for inviting me here. I think James has really set the context. And if we look back over the last 2-3 years, the bigger issues were, you know, around COVID and how that was going to impact Africa. More recently, we're dealing with Russia, Ukraine, and obviously normalization of monetary policy by the Fed and what is happening with rates and all that. So all those things combined, you know, generally have made life difficult for anyone seeking to, you know, access any kind of financing in the capital market. For us at AFC, you know, if I go back to the COVID era, interestingly, our lowest price bond was issued around the COVID era. So, which again says it's not all doom and gloom all the time. There was a window during that period where, you know, it was a risk-on period. Markets were supportive, and we issued quite a number of bonds, you know, despite the pandemic, which was great. But we're dealing with a different scenario right now. I mean, this is a scenario where market is correcting across board. Earlier in the year, we looked at the bond market. And I had breakfast with some bankers this morning, and I said to them that there's a lot of blood on the street. And that's because, you know, the drivers are, you know, the benchmark rate is up, credit spread is up, new issue premium is up. And as an issuer, you just begin to ask yourself that, are you making the right decision if you issue into this market? And for us, honestly, what we decided to do was to just say, you know what, just be ready and hope that there will be a window one day whereby you can access the market at a palatable rate. And that's on the bond side. So, and I think James did mention the fact that beyond the bond market, there are other markets where an issuer like AFC would make progress. And so for us, as a matter of strategy, we've looked more to our relationship banks this year, because I keep telling bankers when I meet them that at least in the loan market, I don't pay new issue premium. So it's more about relationship and ancillary business. So I think as a matter of strategy, it's not doom and gloom. We have several buckets of liquidity, you know, the loan market being one. And for this year, if the bond market continues the way it is, then chances are we probably will focus more of our attention on the loan side, working with our banks like Standard Chartered, and as well as, you know, other banks that can provide longer dated financing. So broadly speaking, that's the way our mind is working. Just one more comment before that's when we look at ourselves and how we fund ourselves. But more generally, we also trying our best to help other African issuers and other African credits to navigate the tough market. Earlier in the year, we supported Bank of Industries, which many people know. We tried to help them, and they had a debut euro issuance even in a bad market. And we're also looking at ways that we can help, other people in the continent that are trying to access the market. So there will be opportunities. We're cognizant of all the risks that we face, but I think we're navigating them carefully.
Thank you very much. Nimrita, you have been waiting very patiently on the phone. You're joining us live from Dubai, as I said earlier. So I'm wondering, you are the head of financing for Standard Chartered. So how are we as a lender supporting African borrowers in all of this?
Thanks. I think perhaps having covered Africa for many, many years, I would say that the last 2 years have actually been a learning, I think. And perhaps the biggest learning that we've taken away as lenders has been prepare for the worst and then prepare a little bit more. And I think we've talked a little bit about some of the issues. We've talked about COVID, we're talking about the war, we're talking about inflation. From an African context, throw in a couple of elections, depreciating currencies, lack of dollar liquidity, and you have got a cocktail of issues or concerns which would deter the most experienced lender. So as I'm such a big TV buff, to kind of paraphrase a famous saying, winter is always coming to a country near you in Africa. It's almost inevitable. So there's always, I think, a bunch of challenges that lenders need to deal with. And I think what we have seen over the last 2 years has been that the borrowers who've kind of navigated this crisis the best are the borrowers who've actually planned and preempted and prepared for the worst. These are borrowers who have actually preserved liquidity and essentially kept their borrowing consistent as opposed to kind of knee-jerk and ad hoc. And it's not always possible. I think, there are always situations where there are short-term and ad hoc borrowings required. But I think we found that the borrowers who've kind of accessed liquidity consistently without any, kind of panicked borrowing are the ones who've actually kind of navigated the situation the best. So from a Standard Chartered perspective, I think how have we helped? I think we've worked, obviously, with our borrowers quite extensively here to support them through, a bunch of, I would broadly kind of put them in 2 buckets. I would say liquidity solutions and then, of course, risk management techniques. Risk management techniques are fairly standard. They cover the IRSs, the cross-currency swaps, commodity hedging. We try and do it on a preemptive basis to kind of, forecast situations into the future and work with clients to kind of mitigate that before the event actually happens. And the second is obviously liquidity solutions that we provide. And I think James alluded to that, which is really, providing medium-term, of course, syndicated loans, which is standard for us. But more importantly, the short-term bridges to capital markets where clients are unable to access them because the markets could be extremely choppy. And very often even bridges to syndicated term loans. And I think any African borrower can attest to the rather long time it takes to get, credit approvals and documentation done. So we're able to support, I think, our clients in that manner. And then finally, but not the least, really provide some of the backstop liquidity solutions for clients who may want the comfort of liquidity, but not necessarily want to shell out the cash because they don't know when they're going to need it. So I think coming up with solutions that allow us to basically support them in that manner.
Thank you so much. And I'm happy to report that Anish Jain, Chief Treasury Officer at the Export Trading Group, has been able to join us from Dubai. Welcome to our panel, Anish. Just perfect timing because the next question is actually for you. So you work for one of the largest African agribusinesses. And I was just wondering, this war that is raging, surely you must see the direct impact it is having on African food security. So what do you see on the ground? How is this impacting consumers, farmers? Tell us a bit more about that.
Thank you, Lisa. First of all, a warm good evening from Dubai to everyone. Certainly, we as an organization and individuals, we are deeply concerned and impacted about the humanitarian crisis this war has caused. But at the same time, we need to play a responsible role as a corporate citizen to ensure that the after effects of this broken supply chain and the war effects does not impact the African smallholder farmers and consumers. We have been dealing in these markets from last more than 50 years now, and we do understand what are the requirements and challenges of these markets. You are absolutely right that availability of food and the security around the entire ecosystem has been breached. What we have seen in many of these markets, fertilizers and agrochemicals have become a major cause of concern. We work with more than 20 development financial institutions across the spectrum, and most of them are engaged with us on a very micro level, how to ensure that we still make sure the fertilizers and agrochemicals reach on the ground, because it will have a cyclical effect where if the fertilizers don't reach on the ground on time, the season will be wasted. And many of the economies in sub-Saharan Africa, which are primarily agrarian economies, their output next year will be very limited. They will have the negative impact on their GDP growth rates. So first and foremost, what we are doing is working with the development financial institutions and our suppliers to ensure that we have the right quantity available in the African countries, and at the same time ensuring that how we can contain the kind of price volatility because of the higher transportation costs. So that's why ETG has been operating on a model where it allows us to do the just-in-time inventory management for many countries. And at the same time, we provide the kind of flexibility for the farmers so that they can come and buy the agrochemicals and fertilizers from us. The second aspect is providing the right food security, where African farmers, what they are producing, once they do the harvesting, there should be an offtake around it. So in order to address that gap and the requirement, ETG has been operating for many, many years to have a farm gate procurement model, which allows us to buy directly from the smallholder farmers, aggregate it, and then take it through our supply chain, where we play a critical role in reducing the post-harvest food loss. We have seen in many countries where post-harvest food loss can be as high as 60%. And with the constant intervention by building warehouse and tangible logistics network, we have been able to bring down this post-harvest food loss to 30%. So I think these are some of the measures that the company has been taken to reduce the impact of the war in the African countries. Back to you.
Thank you so much. Before we lose you, just in case, I have actually a follow-up question for you. You mentioned DFIs, developmental financial institutions, and they play a hugely important role in helping to raise capital from a much broader investor base. So James told me that your organization, I mean, you are at the forefront of really developing a lot of relationships with DFIs, not just in Africa, but all around the world. So what's behind this strategy? Why is it so important? Talk to us.
Thank you, Lisa. And I really like this question because bringing the development impact in the countries where we operate is one of the cornerstones for ETG. We work extensively to provide agronomy and farm extension services to farmers. We also work towards bringing the level of greenhouse gas emissions down. And we also work towards development of females and the women workforce to come into the mainstream. At the same time, addressing issues around climate risk, deforestation, child labor, and these kind of issues. So this way, the kind of development objectives that ETG is achieving on the ground by doing multilateral projects where many of the European and African governments are our partners and sponsors, it allows us to present this entire sustainability platform to our DFI partners. And the objectives that they want to achieve in Africa are fully aligned with what ETG is doing. And all these initiatives are for real, where there are tangible benefits that they can measure and then they can quantify. Nothing is only on the paper where you show a project report and just move on. And when these institutions see the kind of work that we are doing, it gives them comfort that the money that we are borrowing from them is directly improving the income of a smallholder farmer. For example, we have seen in many countries like Malawi, like Zambia, Tanzania, Uganda, Rwanda, and many more countries in sub-Saharan Africa where smallholder farmers who have been associated with ETG, their household income has increased by 2.5 to 3x in last 15 to 20 years. And this is a very tangible benchmark for these development financial institutions to measure the improvement in the incomes and the livelihoods of these farmers, because then it will have the hygiene factor, the education factor, and the entire ecosystem gets strengthened. So I think that's probably the most important aspect where we find the commonality with DFIs.
Thank you very much. I would like to pivot to the ESG theme just for a little bit, because as Nimrita, you keep reminding me a lot of good stuff is happening on the ESG front in Africa, but often we don't know much about it. So Banji, this is where you come into play. You are financing some really interesting projects in Africa. So give us a few highlights.
Yes, so the ESG thing is very important to us at AFC. And just to give a bit of history, as far back as 2015, I believe, we're the first African institution to be accredited by the Green Climate Fund. We also started working with the Climate Innovation Lab as one of the lead promoters of the discussions there. After that, we issued a green bond a few years ago on the back of one of our, I think it was perhaps Africa's first commercial wind farm in Cape Verde, which we're one of the owners. We also issued it on the back of a hydropower project in Ivory Coast. And we also built from scratch another wind farm, which should get to commercial operation this year in Djibouti as well. So on the back of that, we tapped the Swiss franc market, issued a debut green bond. And subsequent to that, obviously, we've been building, a huge platform of renewable assets and just generally trying to be the leader in that space. And so for us, on the asset side, in terms of the investment we're making, it's really quite important that we are, pushing the whole discussion around sustainability, climate risk, how to mitigate, how to manage all that. So that's all part of our investment process. And if I look at the other side of the balance sheet, what that does for us is that once we have this pool of assets, then it begins to open a huge pool of liquidity, which maybe currently we have not tapped enough of that pool. So I think, going forward, I always say to my team that there would come a time, hopefully it's after my time as treasurer, where you would not be able to borrow for general corporate purpose anymore. There has to be something. The funding you're getting has to be solving a particular problem, moving the needle on climate discussion, or just general impact and all that. So I think that's the way our mind is working now, even on the funding side, whereby we're asking ourselves that every single transaction we bring into the market, what exactly are we doing and what problems are we solving? And I think that, to me, may be the direction going forward. So generally speaking, yes, we've done a lot. It's part of our investment process. It's also part of our funding process now as we think about accessing the global capital markets.
Thank you. You talk about what problems are you solving. That's really at the core of your decisions. And Ifti, I have not forgotten you. I know you have been sitting here very patiently waiting for your turn. You have a very interesting background, You are a former banker. You are a former hedge fund manager. You ran your own hedge fund. And now you are the CEO of the African Conservation and Development Group. That's what I would call a very interesting career move. So when you and I chatted on the phone the other week, you mentioned to me a really exciting projects that you're driving in Gabon, and that you're using carbon credits to really move the ESG needle. So I loved it. It was very detailed, a bit complicated. So I'm going to ask you in very plain English, talk to us about this project and what does it do for markets?
Okay, thank you very much, Lisa. For all my sins, I've had a long career in banking. And now I'm working on conservation. And James made the point that there's been a wave that we've been riding, and whilst I was an investor in a fund for the last decade or so in emerging markets, I've seen the ability for emerging market sovereigns to be able to borrow at cheaper and cheaper and cheaper rates, as we've had a very low interest rate and low volatility environment. And that has also fed into corporates, not to the extent that it probably should have in Africa, but it has. And now we're facing headwinds, volatility. The question really for corporates or private companies operating in Africa is one of access to capital and then the price of that capital. And neither of those things are easy when you're a private company operating in, let's say, sub-Saharan Africa, in any of those countries. And one thing that those countries do have is natural capital. Now, this whole concept of natural capital is an extension of ESG in what are the services that, let's say, a country like Gabon, where we work, what are the services that Gabon provides to the world in terms of climate? And the entire Congo Basin, the lungs of Africa, provides huge ecosystem services. In fact, the clean air that you breathe in London comes to a large extent from the absorption capacity of the Congo as much as it does from the Amazon and the other big forests. So all these countries are natural capital rich. And one of the things that we are trying to do as a corporate operating in Gabon, in country, is how can we mobilize the large pools of capital that exist in the traditional markets, such as the bond markets, and what can we offer as an asset or a security for that? If I were to go and fund the projects, we have a series of underlying businesses. We have an agri-business, we have a concession to develop a port, an ecotourism business, and a forestry business. Now, if I were to issue a bond or attempt to issue a bond in the markets against those businesses, I wouldn't be able to do it. Too much risk, I know, because I was a fund manager, and I would look at it and say, nope, that risk isn't worth the return. And if I did take the risk, I would be asking for some egregious rates, and it just doesn't make it viable. So at that point, we turn to the DFIs, and we go hand in hand and say to the DFIs, can you help us? And in fact, we've had some very interesting engagement with the DFIs. Now, just by background, Gabon is 87% forest and is a net absorber of about 100 million tons of CO2 per annum. And Gabon has emissions of about 30 to 40 million per annum. So for Gabon to be carbon neutral, it needs to increase its emissions. Of course, it's not going to do that. It has committed to the UNFCCC that it's going to reduce its emissions, but it needs to be paid for the ecosystem services that it provides. And the same sort of thing that we are doing. We have a sustainable development plan signed in under a sustainable development law that will propagate all of the projects that I've listed in a sustainable manner, bringing economic uplift, jobs, food security, all the things that we want to see, empowerment, education, but not at the cost of the environment. In fact, it's designed specifically to preserve the forest and avoid a huge amount of deforestation. As a result, we will generate carbon credits, and can we use those carbon credits to actually finance the underlying projects? Can we use them as security to mobilize that capital and bring it? Now, when you go to investors, they are so excited. Carbon credits, absolutely. We want to invest, Most of the investors that I've spoken to have the money, but they don't know what to buy or how to buy it. There's an education process. But what I've witnessed in the last 6 months or so is that the financial markets are beginning to suck the carbon development, the standards. It's a very, very nascent market. It reminds me a little bit of credit derivatives in the 90s, where it took you 3 months to settle a trade, and now it can happen in a nanosecond. But we are moving towards standardization. We're moving towards more bodies. And a more standardized product, greater liquidity, and there is more and more finance coming in. The initial finance that's coming in is the larger risk-taking type entities, and there are more stable money managers behind that. But the discussions with the large DFIs is, can we provide open access to the large pools of capital for countries that are natural capital rich, and marry the two together and then feed that capital in?
So that's where you come into play. Fascinating. I love it. James, a virtual audience question has just come in, and I would like to thank all of you for posting your questions here in the room as well. So this one is for you, James. Someone online asked us to provide a bit more insights on Angola and what is going on there. The gentleman or lady mentioned that local currencies have recorded significant gains vis-a-vis the US dollar and the euro, and is also benefiting from higher oil prices. So what are you seeing going on in Angola?
Yeah, well, I mean, obviously with Razia sitting out here, she's much more qualified to answer that question than I am. But I can certainly share my views from a sort of credit perspective and a sort of bond market perspective, because Angola's been a really good example of perhaps the haves and the have-nots. And I think one of the things that we've really seen exacerbated this year is the differential between sovereigns in a bit of stress and sovereigns that can actually access the market. And in fact, Angola very successfully accessed the markets only a few weeks ago. I think from my perspective, one of the reasons that they were able to do that was they successfully graduated from an IMF program. They stuck to their guns and did not issue any bonds for, I think, 2.5 years, something like that, since they agreed at the beginning of the pandemic to enter into the IMF program. They pushed through a number of really, really tough reforms, which frankly a lot of African peer sovereigns have failed to do, and that's perhaps why they are in more trouble than the likes of Angola. And then finally, obviously, we've got a pretty supportive oil price right now, which is always going to benefit at the margins sovereigns that clearly export a lot of natural resources in that way. So from my perspective, that's why they've been one of the outperformers. I'm not a specialist in the local currency markets, but I'm assuming that some of that benefit has also benefited them in the local currency space as well. So that would be my quick answer to whoever it was.
Thank you so much. You mentioned bond issuance, and this next question is coming from someone in the room here in London for you, Anish, in Dubai. So the person is mentioning that you decided not to go ahead with a Eurobond that you announced a few weeks ago. And the question is, how are you funding the gap? How are you going to close that?
Yeah, Lisa, good question. You are putting me on a spot on the on the session. But yeah, I think I must share my open perspective. See, when we announced the transaction, we knew that the market conditions are quite volatile. However, based on our pre-marketing roadshows that we have done, the kind of investor interest and meetings that we have seen, it is quite encouraging and positive. While most of the investors have shown a good appetite to come and subscribe into the paper, but at the same time, the international markets have not been supportive. We have seen in that first week of May when Fed has increased prices, markets have been moving up and down at a very high swings. Most of the investors thought that this is probably not the right time to invest in the bigger quantities. And not only ETG, I believe there have been many issuers in the same boat where they were constantly watching the market and see that if there is a right opportunity and window. But besides this, coming back to your main question, how we are bridging this gap, and I think where I will pick up a leap from what a response Nimrata has provided earlier on, that you need to be prepared well in advance. As an organization, ETG continues to work with our commercial banks and DFIs and institutional investors to ensure that we are engaged with them in having a healthy pipeline in place. I would like to highlight when during the COVID times in 2020 and 2021, when most of the companies have been struggling with liquidity, each year ETG has raised close to $1 billion. So in last 2 years, we have raised around $2 billion of liquidity. A portion has been gone towards repayment and refinancing, and then besides this $2 billion, we have also done refinancing of our existing portfolio of $1.5, $1.6 billion. So when you have the right engagement at the right level, it always allows you to have that kind of liquidity and fundraising activities, which will meet your requirements. Even during these times when there is no bond transactions happening, we have a very great support coming from our commercial banks and from the FIs who have approved large anchor orders with us, and they continue to work with us to support on our liquidity requirements. Thank you.
Thank you so much. I did not want to put you on the spot there, but you answered it beautifully. Thank you very much. We have another question come in, and it's from a borrower perspective. So I wonder, James, would you like to take that as well? It's around bridge financing, and how much more costly is that for borrowers? And does it really, in this current challenging environment, does it provide the right solution?
Yeah, I mean, look, Nimrita as well is on the line, and I'd love to hear her views too, because this is really kind of where the two teams work very closely together here. I mean, just from my perspective, look, a bridge can be extremely powerful. The normal way that a bridge is structured is that it starts out life at a fairly competitive rate. Obviously, there needs to be an incentive for the borrower to actually come to the market and take that out with a long-term solution. So what you'll find is there'll be a point at which the bridge does increase in price and provide that incentive to find that long-term solution for sure. But clearly can operate as a very good way of riding through some of the volatility that we're seeing, or allow an issuer just to get ready to come to the bond market and buy themselves some time and allow them to pre-finance the term financing. But Nimrita, I'm sure you've got a view on that.
Yeah, no, I think, James, I completely concur with your views on this. I think it does, provide that backstop, that liquidity when markets are choppy. You want to have that peace of mind. And it's really actually a toss-up between options, right? I mean, it depends what you're using the bridge for. So if you're using it for a lucrative opportunity while you get to the bond market, I mean, it could be well worth the price. I would argue, yes, it can be more expensive. There's no question about it, because it does tend to be slightly more ad hoc in nature. But nevertheless, I think it's really a function of where that money is getting used. And, sometimes it could be opportunistic, where it could make a lot more sense from the borrower to actually take that bridge while they access the market or the way to access the market. And again, I think one of the other ways we do it is bridge to syndicated term loans. And that can be, again, we're getting 4, 5, 6 banks into a deal. It can be a long, convoluted process. And sometimes it's just easier to get the funds and move on. And that could be, in the long run, you could argue that the cost of the bridges actually kind of makes sense because it balances out.
Thank you so much. We have another capital market access question here in the room. And Banji, I was wondering whether I could pose that to you. The question is around which SSA sovereigns would have to seek an orderly restructuring in order to really gain access to capital markets. And is there appetite for that?
You obviously don't want me to have a job after this.
You do understand AFC's members all happen to be sovereign, African sovereigns, so he's talking about it.
Another question, I put someone on the spot. I do apologize.
No, it's okay. I would just I would dance around your question. Yeah,
Makes for more interesting conversation.
Yeah, so honestly, it's a tough time, and we all have to admit it, that it's a tough time for the continent. I feel sometimes it's a bit overdone by the market. Some of the risk premium that the market is asking for is a bit punitive on the continent. So I think it's important for us to understand that, if you drill down to the fundamentals at the end of the day, there are countries outside of Africa that are worse off and yet have a better preferential treatment by the capital market. It's a bit unfair. I mean, I've always advocated and tried to understand this whole zip code premium that Africa pays. And honestly, hopefully maybe if I decide to do a PhD at some point, that will be my thesis to try and understand why that premium is there. But again, yeah, there are issues. You talk about FX, you talk about maybe debt sustainability, you talk about the overall balance sheet and all that stuff. So when we look at the whole market today, you know, the spreads just kind of, if I'm using what the market is saying, you know, the spreads are quite punitive on Nigeria, for example. And I work for an African institution and I'm a Nigerian, so I probably can say that. But a lot of that is coming from election year, is approaching, you know, some fiscal issues as well, reforms that haven't been done. So that would be a challenge. Will Nigeria default ultimately? I don't think so. Ghana, quite challenging. Used to be the darling of capital markets for many years. We're at an event last week with the president of Ghana, and obviously he spoke very well. Will Ghana ultimately default? Maybe not. There may be IMF and other things and other ways to get around that with time. Angola has kind of turned the corner. So generally speaking, I think, look, across board, it's going to be very turbulent times for many African credits, but eventually, I don't see a spike in default. I probably don't even see defaults happening out of the continent ultimately.
Thank you. That's a positive note. I think, James, you wanted to add briefly to that.
Yeah, no, just very quickly. I mean, I think what it does remind us is that we have to work with our stakeholders and partners across the region to see how we can actually mobilize capital for whether it's sovereigns or corporates or banks that are trying to raise capital in a tough environment. How do we work together? How do we incentivize institutions like AFC, like IFC, you know, et cetera, AFDB, to use their stronger balance sheets to support those that don't have such a strong balance sheet? And that's really the challenge, I think, for those of us that sit in the middle of that quandrum to try and come up with solutions that work. But at least we have got some friends that are able and open and willing to do that.
Great. I think we're coming towards the end of our panel, so I'll plan to ask you one last question to wrap it up. And I wonder, and maybe Ifti, we start with you, since you were the last one to go first. What's the future of financing in Africa going to look like? You talked about your nature-based financing project you're driving. Is that the future? Is that where the market is going to go? What do you think?
I think the market generally wants to participate in climate finance. And Africa is in a very strong position, especially the regions in and around the Congo Basin. The current dilemma that we face in the highly forested countries is that the value of the forest is not fully recognized. You can buy a hectare of forest for 30 or 40 euros, but the ecosystem services that the forest provides to the world are not being valued properly. Now that's starting to change. People are beginning to realize the value of highly forested, low deforestation countries. And for example, the environment minister of Gabon said that if I cut down my forest, then the rain that falls in the mountains of Ethiopia and feeds the Blue Nile will disappear, and 80 million Egyptians will turn up on the borders of Europe. So all of these things you absolutely cannot ignore. The value in Africa that above and beyond all the mineral wealth that has been there and the human capital that is there is natural capital. So I think it is time for the world to pay Africa for the ecosystem services that it has provided for millennia. Otherwise, we will not achieve 1.5 degrees and we will not achieve net zero. And climate finance is the way forward. People like AFC, IFC are going to be absolutely instrumental in that, and the likes of Standard Chartered.
Thank you so much. I'll pivot quickly back to Dubai. So, Nimrita, where do you see the future going?
So I think the future is African. I think, and to kind of elaborate a little bit on that point, I think what we have seen over the past few years has been a decline of international dollar liquidity into the continent, and I think we find a lot of the international traditional lenders kind of more focused on domestic issues. There used to be pools of liquidity. They used to come out of China, but those have dried up as well. So I think but I think if I had to put my finger on one trend, I think it is really the development and the growth of African liquidity by African institutions for African borrowers. And I think it really kind of comes down exactly to institutions like AFC, like AFDB, like Afcs, who are able and willing to be able to support the borrowers across the continent. These are institutions who effectively live and breathe the risks in Africa. They're able to take a slightly more stable long-term view. They're more pragmatic about it, and as such, I think their ability to support borrowers across Africa is, I think, unparalleled and only growing. They themselves are actually extremely highly rated, liquid, able to raise funding at relatively inexpensive costs. And as such, I think it's basically, I would say, the biggest trend that we see across Africa, and I think it's a very welcome one.
Thank you. You mentioned living and breathing risk in Africa. So, Anish, from your perspective, what can we expect to see?
Yeah, I think it's a very interesting point. If I have to summarize in one word, I would say financing in Africa is promising. Though it is very simple to say club Africa as one continent, but it is effectively 54 countries. Each country is having a very different risk profile. You can't compare Ethiopia with Nigeria and Uganda with Tanzania. I believe that the banker should be able to see that what are the right pockets. There's a high GDP growth rate that we can see, increasing demographic and increasing population with higher disposable income, higher educational level. The overall ecosystem in Africa is improving quite significantly and at an accelerated rate. So I see that in next 10 to 20 years, many of the African countries will deliver higher GDP growth rate than you can expect in Asia or in Europe. And that's why the growth looks quite promising, not only from financing, but also from a commodities point of view. Thank you.
Thank you. Banji, would you like to add to that?
Yes, so I think most people have said what I ordinarily would have said. For us at AFC, we always say Africa is not an asset allocation play for us. We don't have a choice. It's only Africa that we do, so we are there and we just have to help the continent to navigate, several cycles. There will be several cycles. There will be good times, there will be bad times, but we just have to be there. We have to be here for good, if I may use that phrase. And I think, just last week in Abuja during our AFC Live, we announced a $2 billion facility for African financial institutions. Again, that's one of the interventions whereby we're pumping, counter-cyclical liquidity through the banking system to just help support all the various countries across the continent. That's just one example. We're also launching a $500 million infrastructure climate resilient fund under our AFC Capital, another way to crowd in capital to climate finance and all that. So there's so many things we're doing, and I think ourselves, other multilaterals, will definitely have to play a bigger role going forward in helping Africa.
Thank you, James. 30 seconds.
Okay, hope, energy, and enthusiasm. And I'm going to try and just tell a very quick story to sum that up. Every year for the last 8 years, I've sort of embarked on this kind of fairly nasty 100-kilometer trail run through KwaZulu-Natal, through all these lovely forests that Ifti are talking about. And at the end of each session, each day that we're running, we come down into the villages near the finish line. And just when you're feeling totally empty of any energy, pretty depressed about life, would rather be in bed somewhere comfortable, a bit like what we're going through in the bond markets right now, actually. We get surrounded by all the children from the village that run out onto the trail and give us high fives and throw out sort of bottles of water and oranges, and it kind of just gives you that lease of life you need to push on and get over the finish line. So that's kind of an example of the hope and energy and enthusiasm that we need to draw on to get through these rough times. But in Africa, there is bucket loads of that. So I look forward to that.
Thank you very much. On that positive note, I would like to thank our wonderful panelists for their great insights. Thank you all for joining us today, both in London and virtually. Coming up next, how are markets riding the volatility tsunami and what is yet to come? Please stay with us. Thank you very much and goodbye.